A lot of people assume that you need to be extremely smart to succeed in the stock market, but intelligence isn't even the top characteristic of a successful investor. In fact, even if you're not a math genius, you can outperform so-called experts and fund managers. The key lies in mastering fundamental traits that shape the right mindset and approach to investing. So let's break down the 5 essential traits every investor should have. First is clear goals. Before you invest a single peso, ask yourself, what am I investing for? Without a clear goal, it's impossible to build a solid strategy. Are you aiming for financial freedom before 40? Do you want to grow your passive income? Or are you simply setting aside money for retirement? Your goal determines your investing approach. It helps you decide whether you'll focus on dividends, value investing, or growth investing. Without a defined goal, you risk making impulsive decisions or investing without a strategy. For example, if your goal is financial freedom by 40, you might prioritize a dividend-focused portfolio that compounds over time. This is exactly my approach. I started small, earning just 1,000 pesos a year in dividends, but through reinvesting and disciplined stock selection, I eventually grew my portfolio to generate more than 15,000 a month. Though it's still quite far from being able to retire, well, I still have a lot of years before I reach 40. I built my portfolio by focusing on companies with strong fundamentals, consistent dividend histories, and undervalued stock prices. Each time I receive a dividend payout, I reinvested it to purchase more shares, accelerating the compounding effect. Additionally, I regularly added capital, strategically buying when stock prices dipped below my computed buy price, ensuring I was maximizing value and future returns. Over time, as my portfolio expanded, my dividend income grew exponentially. I used a strict screening process, ensuring that the companies I invested in had stable earnings and low debt levels. This allowed me to steadily increase my passive income while keeping my investment approach stress-free and manageable, even with a busy schedule. Second is patience. In investing, patience is everything. If you're into long-term investing, which I highly recommend, you need the discipline to hold stocks for years until they reach their full potential. At the same time, patience means waiting for the right opportunity to buy at a price that makes sense. A common mistake is rushing into stocks just because prices are going up. Many investors panic buy at the high prices only to watch their stocks drop later, leading to massive losses. Remember, a great company isn't always a great investment if you buy it at the wrong price. One of the best ways to maintain patience is by investing in strong companies with a solid history of dividend payments and steady growth. When you know that a company has a proven track record of generating consistent returns, it becomes much easier to hold on to your investments through market fluctuations. Instead of worrying about short-term price movements, you can focus on the long-term growth of your portfolio, confident that the businesses you own are fundamentally strong. Patience also plays a critical role in compounding. At the start, the growth of your portfolio might feel slow, and it can be tempting to make rash decisions or shift strategies. However, over time, compounding takes effect, and the exponential growth of your portfolio becomes more visible. Just like Warren Buffett's wealth accumulation, the real magic happens in the later years. So by consistently reinvesting dividends and allowing your investments to grow, patience transforms small gains into substantial wealth over time. Third, strong temperament. Markets crash, stock prices dip, your portfolio might drop 30 to 40%. How will you react? This is where temperament comes in. If you panic and sell everything at a loss, you lock in your losses permanently, but history shows that markets recover. For example, after the market drop in 2008, the market rebounded with massive gains over the next decade. Even in 2020, when stocks plummeted, those who stayed invested saw their portfolios bounce back quickly. However, what if the market doesn't recover as quickly? This is a real challenge for investors in stagnant or slow-growing markets like the Philippines, where the stock market can go through extended periods of little to no growth. Japan's lost decade is another example. Investors who panic and sold their positions during downturns lock in their losses, while those who stayed disciplined and reinvested dividends were in a much better position when conditions improve. This can be seen in my portfolio. Even though the market haven't yet recovered, my returns are quite good, earning an annualized return of 9.99% since inception. And again, this is while the market is down big time. I just stayed consistent with my strategy, not letting my emotions get the better of me. This is why temperament is essential in markets that don't experience rapid rebounds. In a stagnant market, impulsive investors may panic or lose confidence, but those with the right mindset understand that wealth building isn't just about stock price appreciation. By holding strong companies and reinvesting dividends into undervalued stocks, investors can continue compounding their returns even when prices remain flat. This strategy not only generates more dividends over time, but also allows investors to accumulate shares at lower prices. When the market eventually recovers, these accumulated shares capture the full upside, turning what seemed like slow growth into significant long-term gains. By the way, if you want to analyze stocks but always have a hard time finding the data for it, then look no further than simply Wall Street. They have tons of data available, and the way they present it makes everything easy to understand. They offer charts, comparisons, screeners, a portfolio tracker, and updates whenever companies in your watch list release earnings, announce dividends, when insiders are buying or selling, or when a stock falls below its intrinsic value, and much more. Their basic plan is free forever, and if you want to upgrade to a paid plan to get unlimited access, then use my link below to get up to 50% off. Thank you, and back to the video. Fourth, decisiveness. Opportunities won't wait for you. When the market presents a golden opportunity, whether it's a stock at a deep discount or a market downturn, you need to act. Some investors have all the knowledge, patience, and emotional control, but they hesitate when it's time to make a move. Being indecisive can cost you potential gains. A perfect example is the 2020 market crash. Those who bought quality stocks at rock bottom prices saw their portfolios skyrocket within a year. Meanwhile, those who waited for the perfect time often missed out on massive rebounds. Another example is Warren Buffett's purchase of Coca-Cola stock after the 1987 crash. At that time, many critics believed Coca-Cola was already overvalued, questioning why Buffett would invest so heavily in a stock that had seen significant growth. Despite the skepticism, Buffett saw the long-term potential in Coca-Cola's brand strength, pricing power, and consistent earnings. Instead of hesitating, he seized the opportunity, and today, that investment has returned billions in dividends alone. On the flip side, many investors in the Philippines hesitate due to prolonged stagnation, missing chances to accumulate strong companies at undervalued prices. Just like Buffett's decision to trust his research despite market noise, successful investors must focus on fundamentals rather than short-term sentiment. If you've done your research, trust your strategy and make the call. The stock market doesn't wait for you to feel ready. History shows that the biggest opportunities come during uncertainty, and only those who act with conviction reap the rewards. Lastly, adaptability. Investing is not a static process. Markets evolve, economies shift, and unexpected events can alter the investment landscape. Successful investors must be adaptable, able to adjust their strategies while staying true to their long-term goals. I personally experienced this firsthand when I initially focused on growth companies, but later adopted a dividend investing approach after realizing that the Philippine stock market tends to be stagnant for long periods. This shift allowed me to generate consistent income even when stock prices remain flat. Adaptability does not mean abandoning a strategy at the first sign of trouble. Instead, it means having the awareness and flexibility to recognize when adjustments are necessary. For example, in times of rising interest rates or economic downturns, certain sectors may struggle while others thrive. Investors who rigidly stick to one sector or asset class may find themselves with underperforming portfolios, while those who recognize trends and adjust accordingly can maintain growth. A great example of adaptability is how Warren Buffett initially avoided tech stocks, believing he couldn't properly evaluate them. However, as the industry matured, he adjusted his stance and made a significant investment in Apple, which became one of Berkshire Hathaway's most successful holdings. Another example is dividend investors who during periods of economic downturns shift their focus from high-yield stocks to companies with the strongest balance sheets and consistent payout histories. So the key is to remain informed and open to refining your approach while maintaining the core principles of solid investing, buying strong companies, staying patient, and reinvesting for the long term. The best investors are not those who predict the future perfectly, but those who can successfully navigate and adjust to changing market conditions. So at the end of the day, mastering these 5 traits, having clear goals, patience, strong temperament, decisiveness, and adaptability will set you up for long-term success. The ability to stay focused, adjust when necessary, and maintain discipline will separate you from those who get lost in market hype and speculation. So if you found this valuable, don't forget to like this video and subscribe to the channel. See you in the next one.